Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tiangong International Company Limited annual report. Tiangong International Company Limited offers a diverse range of products and services across various industries. The company's manufacturing arm produces alloy steel, cutting tools, titanium alloys, and related products for use in aviation, automotive, high-speed trains, and petroleum chemical sectors. In addition to its manufacturing capabilities, Tiangong also engages in trading activities, including the sale of special steel and goods. Furthermore, the company provides investment management and advisory services to clients. Its product line extends to electric tool sets, die steel, high-speed steel, and power tools kits, which are assembled and sold globally. Tiangong's operations span multiple regions, including the People's Republic of China, North America, Europe, rest of Asia, and internationally. The company's products cater to a wide range of industries, such as machinery manufacturing, home appliances, consumer electronics, aerospace, marine engineering, biological sciences, electronics, and others. Overall, Tiangong International Company Limited is a multifaceted business entity that offers a broad spectrum of products and services across various sectors, making it a significant player in the global market. Tiangong International Company Limited market capitalization of $9 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Tiangong International Company Limited holds a significant advantage in their industry. Tiangong International Company Limited trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 1.12 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the growth side, several key factors contribute to the increase in revenue. The transition from validation to mass production of metal 3D printing is expected to accelerate from 2026-2027, while the penetration of integrated die-casting technology in medium to large structural components also drives growth. The company's transformation into a comprehensive service provider, embedding itself in high-demand sectors such as consumer electronics and aerospace, provides technical support and enhances product performance for downstream customers. Additionally, technological innovations in powder metallurgy and cutting tools contribute to revenue growth. The consolidated audited revenue increase of 25% or more in the years ended December 31, 2026, 2027, and 2028 further supports this trend. On the decline side, several factors contribute to the decrease in revenue. The North American market experienced a significant decline of 21.7%, while the European market declined by 10.6%. An increase in trade receivables resulted in higher accounts receivable, leading to a decline in revenue. Decreases in overseas sales volume and export market for HSS due to U.S. tariff policies also contributed to the decline. Furthermore, the uncertainty of U.S. tariff policy and slow recovery of European markets led to a decrease in export revenue. The decline in demand from consumer electronics industry and others due to decreased export volume also impacted revenue. Finally, an increase in inventory turnover days due to upward trend in tungsten price and short-term lag in sales outbound velocity further contributed to the decline in revenue. Net income experienced fluctuations over the period. Initially, it rose by 11.5% from RMB 358.8 million to RMB 400.2 million on page 1. However, this growth was short-lived, as net income decreased by 3.6% and then further by 2.3% on pages 22 and 26 respectively. Profit margins also underwent changes. The gross profit margin saw a slight decrease of 0.2 percentage points, PPT, from 20.4% to 20.2% on page 1, but showed an increase in specific segments such as DS 14.5% and HSS 16.7% on page 26. The reasons behind these changes are multifaceted. The successful launch of the flagship product, TPMDC-02A, contributed to increased net income on page 1. Additionally, the elimination of reliance on imported high-nitrogen alloy materials enhanced competitiveness and profitability. On the other hand, profit margins increased due to stable demand growth in high-end sectors and a rise in market share of domestic mid to high-end products. The company's financial situation has undergone some changes in recent times. One notable trend is the increase in net debt, which has risen by 3.3%. This suggests that the company has taken on more debt obligations. However, a closer look at interest expenses reveals a decrease, indicating that the company may be benefiting from lower borrowing costs. On the other hand, interest-bearing borrowings have increased significantly, amounting to RMB 663,034. While this may seem counterintuitive given the decrease in interest expenses, it could be due to various factors such as changes in market conditions or shifts in the company's debt structure. The adjusted net debt-to-equity ratio has also decreased from 36% to 35%, which is a positive sign for the company's financial health. Overall, while there are some mixed signals, the decrease in interest expenses and the lower net debt-to-equity ratio suggest that the company may be managing its debt levels effectively. However, the increase in interest-bearing borrowings warrants closer scrutiny to understand the underlying reasons behind this trend. The performance of various segments and regions in the industry has been mixed, with some showing significant growth while others struggled to keep pace. Segments that performed well include the cutting segment, which saw a revenue increase of 0.8% and a substantial adjusted EBIT increase of 273%. The titanium DS segment also fared well, with a revenue increase of 3.4% and an adjusted EBIT increase of 27%. The alloy segment experienced a notable revenue growth of 22.6%, accompanied by an adjusted EBIT increase of 25.7%. The automotive manufacturing industry was another area that performed well, with a significant growth rate of plus 11.5%. Similarly, the railway, shipbuilding, aerospace, and other transportation equipment manufacturing industry saw a growth rate of plus 14%. The high-end manufacturing sectors also drove demand for high-performance tool steel, while patent-intensive industries accounted for over 13% of GDP. In terms of regions, North America performed well, while China was able to overcome technical challenges. On the other hand, some segments and regions struggled to keep pace with the industry's growth. The HSS Tools segment saw a revenue decrease of minus 1.2%, and its adjusted EBIT increase was lower than that of other segments. Management is optimistic about the company's outlook, citing several key developments that will drive growth. Firstly, domestic production capacity and technological standards in powder metallurgy HSS are expected to improve, reducing reliance on imports. This trend is part of a broader recovery in the high-tech manufacturing sector, driven by policy guidance and equipment upgrades. As a result, domestic substitution for high-end cutting tools is accelerating, presenting opportunities for the company to capitalize on this shift. To further enhance its market competitiveness and industry influence, management plans to establish a joint investment task force with Hendrida New Materials. This strategic partnership will enable the company to expand into advanced manufacturing sectors. In addition, the company has made significant investments in Shanghai GZ Clad, acquiring laser cladding and additive manufacturing capabilities. This move is expected to drive growth in the high-end mold service market, further solidifying the company's position in the industry. Overall, management's outlook is positive, with a focus on leveraging domestic production capacity, strategic partnerships, and technological advancements to drive future success. The company has a history of paying dividends to its shareholders. In 2024, it distributed a total amount of RMB 8,185,000. Furthermore, in 2025, the company declared a final dividend of RMB 0.0253 per share for the year ended December 31, 2025. This demonstrates the company's commitment to returning value to its shareholders through dividend payments. Concerns about inventory buildup and supply chain disruption are emerging in the industry. One key concern is the potential for inventory buildup, particularly with higher value items due to increased sales of high-end HSS products. This is evident from a 12% increase in domestic HSS sales volume, which may lead to stockpiling if not managed properly. Furthermore, an analysis of inventory turnover days reveals a temporary rise from 237 to 247 days, indicating that companies are holding onto their inventories for longer periods. If left unchecked, this could result in wasted resources and reduced cash flow. In addition to inventory buildup concerns, there are also worries about supply chain disruption. The instability of U.S. tariff policies has led to poor export performance, causing a decrease in export sales due to uncertainty surrounding tariffs. This has resulted in companies facing bottlenecks in high-temperature strength and thermal fatigue crack resistance for die-casting molds. The industry is also experiencing pressure from clients' surging demand for integrated solutions, which is forcing companies to restructure their supply chains. These challenges highlight the need for companies to adapt quickly to changing market conditions and manage their inventory and supply chain effectively to avoid disruptions. That concludes the financial summary for Tiangong International Company Limited. Feel free to comment below, and I will be happy to answer them when possible.